QuickBooks Online 2025, record the purchase of fixed assets, which could also be called depreciable assets or property, plant, and equipment, PP&E. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 Project 5. We set up in a prior presentation, opening the major financial statement reports as we do every time. The reports are located on the left-hand side. We're in the standard reports under the favorites, right-clicking on the balance sheet to open a link in a new tab, right-click in the profit and loss, otherwise known as the income statement, to open a link in a new tab. Tabbing to the middle tab, closing the hamburger, changing the range to the 25 time frame. That's going to be 010125 tab, 123125 tab. Run it so it can refresh it, and then tab it to the right and repeat the process. Hamburger needs to be closed. The range needs to be changed to the same. 010125 tab, 123125 tab. Run it to refresh it, noting there's still nothing in the current year of the income statement because we're doing those transactions often done when you start the business, which means we have to get the business set up and running before we can start collecting revenue generally. Tabbing to the middle, that process then will typically be, if I bring this down to just the accounting equation, let's bring it down to liabilities and equity. We have assets equal liabilities plus equity, or assets minus liabilities equals equity. Assets being what we have that we're going to use to generate revenue in the future. Liabilities are third-party claims to those assets, and equity is the net value, assets minus liabilities, which is the assets allocated to the owners, whether those owners be a sole proprietor or partner, multiple partners, or a corporation broken out by shares to allocate ownership. So when we start the new business, we did some starting transactions or transactions often needed for the starting of a business. First, getting the capital, that means cash, into the company. And we needed the cash so that we can start buying inventory and property, plant, and equipment. We can do that two different ways. Typically, the owner puts money into the business. So we had an owner investment in the business, and we also could take out a loan. So we took out a loan and we got the cash. So now we're going to start to use that cash to purchase the things that we need to help us generate revenue, which is typically long-term assets, property, plant, and equipment, like building, like equipment, for example, automobiles and so on and so forth, as well as possibly inventory if we're in the type of business where we need inventory. So this time, we're going to be purchasing the fixed assets, the big things that we're going to need for multiple time periods, basically going forward. Now, this is another transaction that isn't one that we expect to be happening routinely as we go through the accounting process. So remember, our general idea is when we record a transaction, if I go into the plus button, we typically do not want to do it with a journal entry, even though you might think that why not? If I learned from a textbook, I learned everything with journal entries. But I want to use the forms when I can because the forms have an added functionality, oftentimes making it easier to link together the bookkeeping process and provide an audit trail. Therefore, every transaction, I want to think, is there a form that's designed specifically for this transaction? In this case, there's not, because unlike the forms that are here, which happen routinely, typically, like an invoice is going to happen all the time, when we pay for normal expenses, that's going to happen all the time. For example, payroll is going to happen on a routine basis. We don't always buy buildings, forklifts, automobiles. They happen periodically. Therefore, there's no form for it specifically. So the next question is cash affected? Because if cash is affected, I can use the cash transaction, and cash is often affected because it's often it's part of all the cycles. It's the lifeblood of the company. In this case, it will be affected if we buy the equipment with cash, which is what we will do this time. Cash is going down, therefore we can use an expense form or a check form. However, note, it's possible cash wouldn't be affected if you financed the equipment. So instead of taking the loan and then using that money to buy the equipment with cash, for example, we might have bought the equipment simply financing the equipment. Therefore, cash wouldn't be affected. We'd have to put the loan on the books and the equipment on the books, in that case, we might have to default to a journal entry. So that's going to be the general process or the form that we're going to use to do the data input. But before we do that, let's do a little bit of analysis on what a fixed asset is, when we have to record a fixed asset, and what are the implications of it. How are we going to communicate with the other people involved, like the bookkeeper communicating with the owner of the business, communicating with the tax preparer or CPA firm to at least do tax preparation, if not financial reporting at the end of the year. So you might be on a cash basis if you're a small business. So if you're a bookkeeper, you might be trying to work with people that are small businesses because you can automate their accounting system using the bank feeds more easily, hopefully put them on a cash-based system to the extent that you can, and then work with the tax preparer at the end of the year to shore up anything that needs to be in order to do the tax preparation. But even if you're on a cash-based system, you can't really get out of having to do an accrual thing sometimes, such as property, plant, and equipment being the biggest example and the most obvious example of that, because the tax code, if you're in the United States, will force you to do that. And the reason it forces you to do that in part is because it obviously is a point where the accrual method is a much better method to be using for income statement comparison purposes. To get an idea of that, let's just imagine, for example, that we're buying a building. If we buy a building for $100,000 and we bought it simply for cash, then what would be the journal entry on a cash-based system? We would decrease the checking account. The other side would go to building expense or something like that for $100,000. Now, for small businesses, $100,000 is going to be a lot of money. It's going to result in a loss. So therefore, if I bought the building this month, I'm going to end up with a loss of like $100,000 because I've got this building expense this month on the books. And then in the following month, for example, I'm not going to have any expense related to the building. So it's going to look like this month was horrible and next month was pretty good in comparison because I don't have that massive expense. When in reality, of course, the building is going to be something that's going to be used this month and next month for a long period into the future. It's a long-term investment. In other words, from an accrual standpoint, we did not consume it, and therefore it should be on the books as an asset, not as an expense. That's usually fairly intuitive to most people. If you buy a building, you're not just going to expense it even though you paid cash for it. You're going to say, it just feels right to put that on the books as an asset. That's because the time frame that we use the building is much different than the time frame when we buy the building, and it's so extreme that it seems obvious to us. So we have to put it on the books as an asset and then depreciate possibly part of it, breaking out land versus building in that case, and depreciate it over the useful life of the building so that our income statement has some kind of comparability as we do the comparison, and that's how the tax preparation is going to work as well. So that's basically what we're going to do. We're going to put it on the books as an asset. Now, logistically, this still gets a little bit messy because you're going to think, okay, what if I buy multiple forklifts or multiple pieces of equipment, and then I have to depreciate these pieces of equipment over the useful life using what? Some kind of depreciation method like straight line or double declining balance or possibly a tax return depreciation method. That's going to be a subledger. So now we're thinking, okay, man, that's going to get messy because that's kind of like if I had the accounts receivable up here, which I can't just have the subledger of accounts receivable as the general ledger breaking out transactions by date, but also need a subledger breaking out the accounts receivable by customer so I can collect by customer. Similarly, the property, plant, and equipment is going to need a subledger breaking out the information in a similar way as inventory is broken out. In other words, breaking out by the actual equipment, the individual forklifts, the individual buildings, and so on and so forth, individual automobiles and whatnot that support this number. You would think that supporting information would be in QuickBooks, but typically it's not. And that's in part because in the United States, we have to do tax preparation, and QuickBooks isn't designed to do tax preparation software. Typically, the bookkeeping software and the tax preparation software are different because the tax code is so complicated. It has its own ins and outs and updates that need to be made to it. So you can't really integrate the two things like you would like to be able to do, which would make things a lot easier if you could, but you just can't because the tax code is too complicated. That means the tax code has its own depreciation schedule, and that means you're going to have to make a subsidiary ledger in the tax software anyways, because you're going to need that to do tax depreciation. So it doesn't really make sense to do another very complex depreciation schedule in QuickBooks and one in the tax software, because it's going to be quite likely that the two will not reconcile, not just because you're using different depreciation methods, but even like the cost might not reconcile and so on and so forth. The grouping will get out of sync and it'll be a mess. So it's actually a little bit easier in some ways in that the tax software is usually going to be where the subsidiary ledger will be, and then we will just do periodic adjustments on our side, recording the depreciation journal entry as an adjusting entry, which we'll do in a future course or section periodically, possibly monthly, quarterly, or on a yearly basis. So now the next thing we have to kind of realize then is that we're going to have to use a tax depreciation for the tax return. But the depreciation for taxes is not ideal for bookkeeping reporting purposes because there's tax laws which have different kind of objectives than simply reporting objectives. So if you're a small business, the decision will be, should I just record it on a tax depreciation method? Because that will be easier so that I don't have to use the tax software to make two depreciation schedules, one for book depreciation, one for tax depreciation. Or should I ask my tax preparer to make two depreciation schedules, one using tax depreciation, one possibly using just a straight double declining balance or a straight line method depreciation for my internal bookkeeping or my financial reporting as opposed to tax preparation. A little bit more complicated, but most tax software can do that. So you want to kind of keep that in mind as something that we want to deal with, which we'll talk more about when we get to the adjusting entries process. As we actually enter the transactions into the system, note that this balance is already there, so it's going to be on the subledger. So if I go over to my subledger, I'm going to imagine this is the kind of report that you would get from your tax software. And I'm going to imagine it's 2023 and 2024. Let's imagine these 23s were 24s and these 24s were 25s, right? Because our cutoff this time is 2024 is the prior period, and then these are going to be the current period, is what I'm trying to say, just to get an idea of our example here. So you can see on this worksheet, if I was to add up, for example, using the trustee calculator, everything from the prior year, this is going to be the cost of the furniture and equipment, which was 15 plus 23 plus 12 plus 5 plus 2 plus 3 plus 7 plus 8 is 75,000. I took off the zeros, 75,000. That's what we have over here, 75,000, right? So that's what was on there last year. Notice it's supported by the actual items, a sofa, a chair, recliners, and so on and so forth. So it's really important as we do these depreciation schedules to find a good tax preparer that's going to make a detailed subledger, noting that it won't really affect you if they do not make a detailed subledger until time passes and you try to sell or dispose of something, at which point you will run into a mess if you don't have a detailed subledger. So for example, if you bought 5 forklifts and your tax preparer put them on the books on one line item for 5 forklifts, then when you sell one of those forklifts 5 years later, you're going to end up with a problem, because now they're going to have to say you sold one out of the 5 forklifts that were on the books as one line item. And I don't know. So now I'm going to have to break it out and sell one of the 5. That's going to be a mess, right? Or they put 5 individual forklifts on the books, but they didn't properly identify it with basically the license number or whatever number that you can have for the forklift, so that when I sell one of them, I don't know which one I sold. So I won't be able to identify on the subledger to the physical unit that we have. So this is unlike inventory, noting that inventory, when we have a lot of the things are exactly the same, we use a flow assumption, first in, first out, last in, first out, weighted average. With the fixed assets, the items are unique in nature. Therefore, we have to identify the actual item, being able to see them on the report and tie them out to what's on the actual ground in the office. So if you're talking about sofas or something, you possibly want to be more specific about what exactly the description of it is, as well as chairs or whatever it is. You want to be as specific as possible and make sure that they're not putting it on there as just general furniture and equipment and then just have the amount on it, right? So that also means that because these transactions don't happen all the time, the beauty of these types of transactions is if you did everything proper in the past, all of the prior stuff from the prior year will be on the books the same because you didn't, unless you disposed of it, right? Because it's already on the books. All you have to do is give to the tax preparer the current year's stuff. And usually there's not that many transactions. So what we need to do is make sure that we give the backup data to provide to them the current year transactions. That means anything that was disposed of in the current year and anything that we purchased in the current year, we want to provide that to the accountant. Okay, so that means that when we record this transaction, I possibly want to keep the invoice. I want to keep the invoice and maybe upload that to the system as an attachment so that when I provide my QuickBooks file to the tax preparer, they not only see the increase in the equipment that's in the general ledger, but have the detail they need to put it on the subledger in as much detail as possible is going to be the general idea. Now, another problem often comes up with the purchasing and selling of equipment, and that is that we might have a trade-in if we sell it, or even if we purchase a new piece of equipment, there might be a trade-in and there might be financing involved with it. If there's a trade-in or financing involved with it, it's going to be a complex transaction to put on the books. As a bookkeeper, we might contact the CPA firm and say, hey, look, could you make this journal entry for me? Or basically tell me what the journal entry would be based on this documentation. Even better than that, however, might be, look, I'm just going to keep my books on a cash-based system. So if I purchased something and there was a trade-in and there was a financing of it, all I'm going to put on the books when I purchase it is the deposit that I put on the purchase, right? Because that's going to come through the bank feeds on a cash-based system. And then when I pay off the loan, I'm going to start making a loan account for the loan payments because that's a cash-based component. And then I'm going to make sure to keep all the documentation, provide that to my CPA firm or tax preparer at the end of the year so they can fix everything they need to fix, meaning make the transaction proper according to the purchase documents, the loan documents, create the amortization schedule, break out short-term and long-term portion of the loan, and record the proper amount of interest. They're going to have to do all that stuff anyways, typically, and if you record it incorrectly, it's actually more work to them. They'll have to unrecord it, they'll have to reverse it, and then put it back on the books according to the proper depreciation schedules and whatnot. So that oftentimes is actually an easy way to do that as long as you're communicating well with your accountant. The other thing to keep in mind is that when you first start up the company file, you want to group your property, plant, and equipment in the same grouping format as is on the QuickBooks, as is on the subledger, on the tax return. In other words, this is where QuickBooks General Ledger, if I go back to the GL over here, and I go into, let's go into the transactions and then close up the ham boogie and go into the chart of accounts. And if I go down to the fixed asset accounts that they gave me, this is kind of the exception to the rule. Remember the rule being that I'm going to use their chart of accounts to the extent that I find an account that suits my need as I do the data input. And then I'll go in and adjust their chart of accounts names if I don't think the name is exactly what I want. But in this case, they've got all these accounts for the fixed assets, which aren't really what is typical on a tax return, which is where the subledger is going to be created. So I would make sure then that you start off by talking to the accountant and saying, what are the general categories on the subledger from the tax return for property, plant, and equipment, so I can group it similarly on my side so that I can make the adjusting entries as easy as possible. In other words, my balance sheet accounts over here for property, plant, and equipment should tie out to the major subcategories that are on the subledger generated by the tax return. If they don't, you're going to end up doing this to tie out what's on the books to what's on the subledger. You're going to have to add and subtract all these different things, which as time passes, as the subledger gets more complicated, will become a mess. So this is one of those things you want to make it as tight and clean as possible from the beginning, because over time it'll start to get wonky over time, right? And so you want to make it as clean as possible from the start. All right. So in our case, we already have these on the books for what do we have 75,000 in furniture and equipment. I'm going to keep that as the general category going forward, and then I'm going to imagine that we purchased these items. I'm going to say we purchased, let's say, the 7 plus the 3 plus 2 plus the 4. I think it's $16,000 worth of stuff, which I'm going to imagine was office desk, office table, office chairs, which again, these should be more descriptive. I'm going to imagine all that detail is on the invoice. We purchased it from the same spot, and I'm going to put it on the books at the one time. All right, so we're going to imagine we just paid cash for it this time. So if I go to the first tab, I could use an expense form like this, or if I paid for it with an electronic transfer, I would see it come through the bank feeds, which would be in the transactions and the bank transactions. So we'll talk about bank feeds in a future course or section. If it came through the bank feeds, we would need to be careful when we pay for stuff, that, especially stuff that comes from an office supply shop, possibly using a dollar amount limit, so that if the amount is over a certain dollar amount, that's going to be an indication that possibly we can't just expense it as, say, office supplies or something like that, but rather might have to put it on the books as property, plant, and equipment, as is required most likely by the tax law. So you might do a dollar limitation so that you can double check on certain items to see if you have to put it on the books as an asset. But we're going to be going into our register. Let's go into the register again in the chart of accounts. I'll close up the ham boogie. We'll go up top into the checking account. I'm going to go into the register, and I'm going to enter it directly here as a expense form. And we'll put it on 010925. And I'm going to say it was Office Depot. So we're going to add Office Depot on the fly as we go. It's adding it as a vendor. That's what we want because we're paying Office Depot. I don't need any more information than just the simple name so I can pay them. Okay. Memo. We're going to say purchase PPE. And I might say like see invoice attached. And so we're going to make the payment. We'll say $16,000. And the other side's going to go, I'm just going to put it directly into furniture and equipment, which is going to be an asset type of account rather than expensing it, as is typically the case, what we would do when we buy stuff. So what's this going to do? Decrease the checking account. The other side's going to go into an asset as opposed to an expense. No impact on the income statement, and it will create a full expense form. So I'm going to say, all right, let's save it. Let's go into the balance sheet, run it to refresh it, and now I can go into the checking account, drilling down on the checking account. All right, so there's the 16,000. There's the expense form, name Office Depot, line description, and then the other side went into furniture and fixture. 16,000 decreased to the checking account. Let's go into it. It will take us not to the register, but rather to an expense form, long format instead of the short format of the register, noting down here that I can add an attachment. So this is where I would go to attach the invoice as a PDF so that when I go to the tax return or tax preparer, what they're going to do is they're going to say, hey, look, let me check out. Let's go back here. They're going to go into the furniture and equipment, and they're going to notice that this number doesn't tie in to what they have on the tax return for the prior year. That's what they should do. They should reconcile the two, right? And they're going to go, okay, wait a sec, this doesn't tie into my depreciation schedule, and so then they go into the detail and say, oh, 16,000 was purchased, but 16,000 isn't enough information because we actually made that purchase. If they put it on the books for 16,000, it's going to be a mess. They need to put it on the book for each individual line item, which hopefully will be described on the invoice. Instead of them having to call you to get the invoice, we're going to say, hey, look, we added the invoices for all the furniture and equipment as an attachment so that they can find it directly in the file, pull up the invoice, which if there was a loan attached to it as well, we'll give them the loan document and all that kind of stuff so they can put it properly on the books. And we're going to make sure that they do it on our end. We're going to note that there was a change to the depreciation schedule. We're going to make sure we mention to the CPA firm, make sure that you adjust the property, plants, and equipment. We need the depreciation schedule. If there was any financing, I'm going to let them know the invoices are attached. So do that, please. Otherwise, it's going to be a mess going forward. All right, so that's good. So now we have the furniture and equipment. Now, if I go to the income statement and run this, nothing's on the income statement because we haven't expensed it. When will it be expensed? It will be expensed in the form of depreciation, and we will record depreciations according to the depreciation schedules provided by the tax software, possibly monthly, quarterly, or maybe yearly, depending on our needs. All right, let's go back on over to the first tab. All right, let's do one more, and we'll just do the same thing, imagining we bought more equipment. So I'm going to go to the first tab. I'm going to go back into the register. So let's go, let's close up this for now. We're in the register. So once again, I'm in the chart of accounts, which is under the hamburger, transactions, chart of accounts, close the hamburger, going into the register to the checking account, then selecting the drop down. I'm going to make an expense type form, and I'll make it as a, let's just do the same date, I guess. And we're going to say this time, though, it's going to go, let's just say Amazon. So we're buying stuff from Amazon. Remembering if this was done with an electronic transfer, then you might buy multiple things from like an office supply shop. I'm going to just add it as a vendor generally. And that means it's going to be more difficult to just memorize the transaction. Because if I buy something from like Office Depot, Office Max, Office Supply Store, Amazon, or something like that, it's most likely usually office supplies. But again, if the dollar amount is fairly large, it might also then be, it could be inventory or it could be property, plants, and equipment. Therefore, you might have to be careful because once we enter transactions, it'll start to memorize where we recorded it last time. And with certain things, it's always the same. Like if you pay Verizon, the telephone bill is always the same. But for some things, it'll differ. So I'm going to say this is going to be the memo, what we bought, office, equipment. And then I'm going to say, and I might say see attachment. And then we're going to say this was 7,000, let's say. And the other side, I'm just going to put it into furniture and equipment again. Now notice furniture and equipment is not the actual categorization on this subledger. Furniture and fixtures and machinery and equipment. So I'm going to keep it there for now, but later I'm going to fix that. I'm going to try to fix it to tie it out to what's on the subledger exactly to make it easier going forward. This transaction, once again, will decrease the checking account by 7,000. The other side going into furniture and fixture. Let's say save it, go into the balance sheet, run it to refresh it, go into the checking account to see the detail. And we have a decrease to the checking account. Wait a sec, I put it on there on 3/5. That's the wrong date. Let's fix the date. Should be 1/5 or 1. What should it be? Let me do this. Let me go back in here. This needs to be fixed. So the date, let's make it on 01/11/25, let's say. So that's a common problem when you're working practice problems because it's going to put the current date in place. So if you would run into a problem, your numbers don't tie out to my numbers, then check the dates, right? So we'll see that in a second. So I'm going to save it and close it. So there's the expense form. that is created. Once again, on that expense form, you can create an attachment to put the detail of the invoice. Let's go back and let's refresh this. So make sure it picks up the right date. And then if we go down to the furniture and equipment, we see then once again, Amazon, there's the other side on the 7,000 within here. All right, let's go back up top. So we can see also we're going to expense it later with another account of accumulated depreciation, which is what we call a contra asset account. And we'll talk more about that in future presentations. Just noting, you also have this kind of issue of how am I going to record the accumulated depreciation? I could have just one account for accumulated depreciation of all of the different categories of fixed asset, or more likely, I have multiple accumulated depreciation accounts for each category, such as furniture and fixture, machinery, and equipment. We'll talk more about that in future presentations. For now, this is where we stand. I'm going to open up the trial balance. I'm just trying to scroll through so you can see it. Check your numbers. Let's open up the trial balance because that's the best report to check our numbers with. Let's go to the first tab to do that. Open up the hamburger. Go down to the reports. Type in trial balance because that's what we want to be opening up. Close up the hamburger. Change the range for 2025. 010125 tab, 123125 tab. Run it to refresh it. This is where we stand. Here's our two legs. Here's the two legs we're standing on at this point in time. Notice that the trial balance is the balance sheet on top of the income statement. If your numbers don't tie out to these numbers, again, it might be a date range issue. How could you check if it's a date range issue? Run your report for a later date and see if your numbers change. If your numbers change, possibly being correct, if you run it for a later date, then it's a date issue. Look for that number that changed. Drill down on it to the source document. Look for the date that is different than the time frame we are in, January of 2025, and then make the adjustment. And you might want to run this for January, just January 010125, because you might be in 2025, because we will be doing February of 2025, right? So run it as a January 31st, 013125. Let me try that again. So that you make sure that you have the cutoff correct as of January 31st, and then we'll do some transactions in February. And again, if your numbers don't tie out, then try to extend the date range, look for the difference, drill down on it to the source document, adjust the date.